All right, my friends, today we're going to figure out how to calculate taxes in retirement. That's what we're going to talk about here today in probably a 2 or 3 part series, maybe even 4 parts, because we're going to use a case study after we show you the basis here, the basics, and then we'll dive into a specific case I was using earlier today with a client. So, welcome to Heritage Wealth Planning YouTube channel, my friends, the place that you come to learn all about taxes in retirement and all kinds of retirement planning techniques. If you like what you see, subscribe, and then don't forget to hit the bell to be notified from future content. So let's dive right into this real quick. The first thing we have to do is we have to figure out what our income is in retirement. So we're going to assume we're a married couple filing jointly who are, it doesn't matter, over 65 years old or over 64 years old. There's a reason I say over 64, but married couple filing jointly, we'll just say they're 66. They have $30,000 of Social Security, they got $15,000 of IRA, and they got $10,000 of tax-exempt interest. So their total income, the amount of money that they have coming in, which they can spend, is $55,000. So they say, Josh, I want to know how much taxes I got to pay. And I say, okay, let's dive right into this. So we're going to look at it. First, we have to figure out what their provisional income is. And the provisional income is simply how much of their Social Security benefit is subject to taxation. That's it. Nothing more, nothing less. And because they're married filing jointly, that's a big deal because the provisional income rules are different for a married couple than a single or a widow in the late case I was using today. And in another video and part of the series, I'll show you how different it is because it's painful to watch. So to figure out your provisional income, you take half of your Social Security. So remember, the Social Security is $30,000, half that's $15,000. We take all the other income to include their tax-exempt interest. But Josh, you're full of crap. Tax-exempt interest isn't subject to income tax. You're right. It's not subject to income tax, but it's certainly subject to Social Security tax and as well Medicare premiums too, mind you. So we have $15,000 of IRA, $10,000 of tax-exempt interest. That's $25,000 total. 15 plus 25. I don't even need my trusty calculator to figure that out. Watch this. That's $40,000. All right. As you can see, I already wrote all this down. Anyway, $40,000 is our provisional income. Now, how much is our Social Security based on that $40,000? Well, if you're married, the first $32,000 is not taxable. The next amount between $32,000 and $44,000, half of that amount is taxable, and anything above $44,000 is 85% of that amount is taxable. In this case, we've got provisional income of $40,000. 40,000 minus 32 is $8,000. We times that by 5.5 or 1/2%. And so we have $4,000 is our taxable Social Security, $4,000. So of all $30,000 of Social Security, only $4,000 is taxable. So let's write that down. Taxable Social Security, $4,000. All right. So let's go ahead and clear this off here. Take my trusty spray gun. Spray, spray, spray. Spray, spray, spray. Take my trusty towel here. Hopefully it's not too dirty. It looks all right. And we're going to wipe this off. We're going to wipe that off. We're going to wipe that off. We're going to wipe that off and looking good. Ought to be, you're looking good. Ought to be where? Hollywood, that's right. I hear some of you out there, CB. I hear some others out there. My friend Steve from New Jersey, I don't know what they sang in the Marine Corps for cadences, but we in the Army say looking good ought to be in Hollywood. So, all right, so now what we got to do is we got to figure out our AGI, our adjusted gross income. And how we do that is we take our $4,000 of taxable Social Security, all right, so $4,000 of taxable Social Security, plus we take our IRA, $15,000. Now, again, I just have IRA for simplicity. It could be $7,500 from a pension, $7,500 from an IRA. It doesn't matter. At the end of the day, it's just, we're going to say it's a distribution from a qualified retirement plan or an IRA, a non-Roth IRA, but just something that's taxable in the very first penny, which this certainly is. So our AGI is now $19,000. All right, so far so good with me. Now, what's our standard deduction? Remember, these people are born after they're over 64 years old, which means their standard deduction is $26,600. $26,600. So now we take our trusty calculator, because I can't figure that one out, to see what our taxable income is. So we got $19,000 minus $26,600, and we have negative taxable income of $7,600. We have no taxable income we actually have negative income of $7,600. Okay, so we have, again, you take your AGI, you got to figure out your AGIs, your taxable Social Security, plus your IRA distributions, or whatever other kind of income, not including tax exempt here, because that is where, again, tax exempt is free from income tax, so it would not be subject to AGI. $19,000, you take your two standard deductions of $13,300 if you're married, because you're over 64, and you have a negative income of $7,600. And that's how you figure out your taxes. In this case, you owe none. Now, next episode, we're going to show you what happens if they did a Roth distribution to take advantage of that negative tax account that they have. So stay with me. Don't forget to subscribe. And of course, as always, comments are welcome. We'll see you next time.